Welcome to Janken's Code on Risk, the YouTube channel dedicated to the theory and practice of risk management. In this video, we're going to talk about exposure-based cash flow at risk and how you can implement that in a spreadsheet model. And for more on cash flow approaches to risk management, please consult my book, Empowered Enterprise Risk Management, co-authored with Peter Kapstad. There's also more information on my webpage, riskbudgeting.se. And as they say here on YouTube, please like and subscribe. So cash flow at risk is a measure of risk, a risk statistic that deals with the risk inherent in corporate cash flows. And usually we're talking about operating cash flows, but any other version of cash flow is perfectly possible. And the question being asked is how low can operating cash flows go over the next year or quarter with a specified level of statistical confidence? So there's a statistical dimension here that is important to see. We're not asking how low can operating cash flows possibly go, because that could be very well be zero, right, in some extreme scenarios. So we're talking about a certain level of statistical confidence here, and the cash flow loss, the maximum loss we could sustain with that level of confidence. And so, for example, then if you say that E-CFaR is 494 million with 95% statistical confidence, that will be the same thing as saying that we're 95% sure that cash flow will not fall below 494 million in the next quarter. Equivalently, you could say that we expect cash flows to fall below this level in only 1 out of 20 quarters. So that's the same thing, only rearranging the furniture a little bit. So here we illustrate graphically in the simulated distribution for cash flow, where if you follow this line here, that's the line associated with 5%, the fifth percentile, if you will. And so that to the left of this line here, you have 5% of the probability mass, meaning that there is indeed a 5% chance of going below this level. All right, and you have 95% of simulated outcomes for cash flow to the right of that line. So that would be the cash flow number in this case. 494 is the value associated with a 5% probability of going below that level. So if you had selected another confidence level, let's say 1%, you would be out here in the distribution, and the cash flow at risk value associated with that level would have been different, much lower number, obviously. So you have to choose a certain level of statistical confidence involved in this exercise. So all the simulations in this video are done using at risk. It's an Excel add-on for risk simulations in spreadsheet models. So prior to exposure-based cash flow at risk, there were two main approaches around for generating cash flow at risk estimates. And one was the bottom-up approach, in which you basically forecasted the firm's business plan, bottom up, these volumes of sales volumes and cost estimates and so forth. And you connect market risk factors like the exchange rate, interest rate with those cash flows. So you describe that in your model, you quantify some link between market risks and corporate cash flows. And then you simulate the market risks and you derive a conditional distribution for cash flow, because you have specified a link. So whenever you simulate the market risks, you will get a conditional simulated outcome distribution for cash flow. So from using which you can derive any risk statistics, for example, cash flow at risk. And there's also the top-down approach to cash flow at risk, in which you pool lots of data for a large number of companies. The idea here is to increase the statistical power by getting lots of data points to estimate your outcome distribution with. And what you do is you analyze in this data set which firm characteristics are associated with more or less cash flow volatility. So, for example, in certain industries, there's more cash flow volatility. firms with a certain size have a systematically different, let's say larger firms have a systematically different cash flow volatility than small one. So, and so on. So you can, along a number of dimensions, you can characterize, what factors drive cash flow volatility. And then you take your firm's characteristics and use that to sort of derive a conditional distribution for cash flow volatility, or E-CFaR. So you basically just utilize the statistical power from having lots of data, but you take your firm's specific characteristics to find the appropriate sort of cash flow distribution for your firm. Then I'm one of the authors, by the way, of this paper, in which we criticize these existing methods because, well, first of all, the bottom-up method focuses only on market risk. And that is useful for hedging decisions. You can't develop a risk management strategy successfully unless you know your exposures in the first place. But what matters is total cash flow volatility for investment programs and meeting debt obligations, etc. It's the total available cash flow that matters, not the conditional market risk-driven part of it. The top-down method, for its part, it lacks the information then on these hedgeable risk exposures. So how could you can't really execute a risk management strategy or evaluate it and see how that will impact your risk profile, because you haven't specified the exposure in the first place, so you have nothing to sort of target in terms of netting or changing a sort of net exposure in the model, right? That will lead to a lower or more desired risk profile. So we're saying that, okay, what if you could combine information on market risk exposures, but still have something that describes the total cash flow volatility and connect that with managerial decision making? So that is what led us to develop exposure-based cash flow at risk. The basis for which is an exposure model estimated using regression analysis. So we take historical data for the firm we're interested in now. So some measure of cash flow is going to be the explanatory variable here. So we use data to estimate how sensitive this firm's cash flow is to changes in risk factors. So risk factors could be exchange rates, interest rates, commodities, and so on. And these coefficients here will inform us about the extent to which our cash flow is exposed or sensitive to changes in these risk factors. So if this is an exchange rate, and this coefficient here will tell us if there's a change in this exchange rate by so and so much, this will translate into a change in corporate performance by so and so much. And this is what the coefficient here tells us about. So we now have the information to design sensible risk management strategies, but we also have a way to get total cash flow volatility, because the error term here captures all non-market risks or all sources of variability in corporate performance that is not related to one of the risk factors in the model. So if you're able to put together the market-based volatility or the volatility conditional on market risks, but also have information on non-market risks, so you can get the total. So here's a model for Equinor, a Norwegian energy company. We've estimated a model for the changes in cash flow as a function of changes in the oil price and changes in the Norwegian krona versus the dollar exchange rate. And this is actually as expected. This is a company producing large quantities of oil and then converting that back into Norwegian krona. And indeed, the model informs us that there is a positive and statistically significant relationship between cash flow and these two risk factors. And here we have also estimated the variability from non-market risk factors. So to implement this in a spreadsheet, we need to just write the model, the exposure model into a spreadsheet, which is what we've done here. So we're typing the intercept, the coefficient on oil, etc., and the standard error We're also going to need a cash flow from the previous quarter because the model is expressed in first difference or the change. Whereas, if we want to get the actual forecast for cash flow in the fourth quarter, we would have to add that simulated change to the ingoing value to get the level of cash flow in the next quarter. So how could we then come up with forecasts and simulated numbers for these risk factors? Because that we need for the conditional part of CashFlowatRisk, right? So we're going to propose these very simple AR1 models of autoregressive models of order 1, where you basically just regress a variable on its own lag value. So we're explaining this quarter's exchange rate with reference to the previous quarter's exchange rate and an intercept and some randomness around that. So usually what the price is now is very meaningful for predicting the price in the next quarter. So these models they do very well in terms of forecasting ability, yet they're very simple and intuitive to use. So let's just go for that. And we do that now for both these risk factors. You can find in other videos how exactly we do that. But we execute these regressions and then we write the information we get from that into Excel here. So this is the intercept and this is the AR1 coefficient, and then we need a standard error as an indicator of the uncertainty around that forecast. Again, we're going to need the ingoing values to be able to generate forecasts for the next quarter. So we set the model up. Here we have the forecast for the oil price, which is then just an implementation of the AR1 model. It takes the intercept, and to that it adds the coefficient then times the ingoing value in Q3. So this is the starting value or previous quarter's value, which is linked up to the forecast here then. So that's very simple. That generates the forecast of 46. And we can compute the change in the oil price as a difference between these two cells, right? So it's a full increase in the oil price in between these two quotes. All right, so that's all very straightforward, and we do the same thing for the exchange rate, and we're good to go. But since we want to simulate, we're also going to turn this into a risk function. We use this feature in @risk, and here now we have what we just did was to generate a forecast. So this is the forecast, and then we take the standard error as a proxy of the magnitude of uncertainty around that forecast. So the standard error here captures the uncertainty around this forecast. So that makes it possible to simulate, because we can instruct the program to draw random values based on this standard error here around the forecast in each scenario, giving you a new simulated exchange rate and oil price, which you're then going to feed or send. You're going to pass that on into the exposure model, which is what we're doing here. So now we're coming back to the exposure model that we entered into the spreadsheet earlier. And we're going to create a forecast, first of all, for that. So we're using the exposure model here to generate a forecast. So number one, take the previous period's cash flow, and that's your reference point. To that, you add your forecasted change, which is given then by the exposure model. First, the intercept, and the coefficient on oil over here times the change in oil price. And then the coefficient on the US dollar times the change in US dollar, which you simulate over here. Now remember that this is 0 in the forecast, but when you start drawing thousands of random simulated outcomes, there will be positive and negative values appearing in this cell, but you connect those with your cash flow performance using this model. So you derive a conditional forecast and a conditional simulated value for cash flow here, right, using the exposure model. And we're going to designate it as a risk output in @risk so that it keeps track of the simulations for us. So let's do that. Now we're ready. We can push the button and simulate. So we're setting the model up here then, and using this feature in @risk, we're able to see the simulated distribution for cash flow in the next quarter. So around this forecast, we're deriving thousands of new values conditional on the simulated values for these two risk factors then. So this is a conditional distribution. We're just sending this information through the exposure model and obtaining this conditional distribution as a result. And I apologize to all the risk philosophers out there who see red when all these all these bell curves are on the screen, but we're keeping it reasonably simple for now, so don't worry about that too much. Anyway, we're of course we would correlate these things as well. We're not going to do that here because we're again keeping it simple. But these two risk factors are co-moving, or they correlate with each other. So you would incorporate that. That's very easy to do, and we'll cover that in other videos. But we'll leave it out here just to have some progress here towards the goal. And here we're asking the program at risk here to show or report the cash flow at risk number directly. That's very convenient to have it appear in the spreadsheet immediately. I mean, you could go to this distribution and sort of try to read it, and you'll find it here, but it's kind of nice to just have it directly reported. And the way to do that is to use the risk percentile function here, which instructs the model to, okay, collect or fetch this number here, the cash flow simulated outcome, you know, and take the fifth percentile of that distribution and show it in the cell, which is what it's doing here. So we get the cash flow risk number reported in the spreadsheet. So we managed to get the number we wanted, except that we're forgetting one thing. We were talking about non-market risk earlier. What happened to that? Well, we shouldn't leave that out of the model here, because we have the information and we need to incorporate it somehow, because that's when it becomes total cash flow, much more relevant than for managerial decision making. So the way to do that is to incorporate or sort of use the standard error from the exposure model now, in the same way that we use the standard error from the ER1 models before. So in this case, it has a very neat interpretation, right? That it's all the non-market risk sources of variability, and we instruct the model here to draw random numbers based on this standard error around the forecasted value of cash flow, because this is what we do here. Right? We generate a forecast, but this is the uncertainty around the forecast. So we're able to sort of add that, incorporate that into the simulation. So we have both the non-market sources of risk and the market sources of risk over here, giving us a total. So this is what, and by the way, as you can see here, there's now more risk, which is what you would expect, because you've just added a lot of uncertainty here. All the non-market risks are most likely going to be quite significant in most firms. So cash flow goes even lower in this outcome distribution. Makes sense, because their non-market risks are by definition in this approach uncorrelated with the market risks. So it's going to add to risk, which we see here as a lower cash flow at risk number. So now we're 5% sure that it won't go below this number. As you can see over here, that's this line here represents 5% of the probability distribution here. It's on this side of it, and that's the cash flow at risk number. So what happened then actually in that quarter? Well, it was 5.4 something over here, so it's well within the distribution. And if you were to repeat this a large number of times or roll it over many quarters, you would expect that the actual cash flow number ended up in the tail. So like if we're focusing on the left-hand tail, you know, you would expect that in roughly 5% of the quarters, the actual number would be outside what you simulated as cash flow at risk and going into that quarter. But how you do that sort of testing is for another video. But all right, we now have the cash flow at risk estimate in the spreadsheet as we set out to do. And so to sum up, cash flow risk measures the cash flow loss, sort of maximum loss associated with a specified confidence interval. And if you have information on market risk exposures, you can use that for designing risk management strategies to sort of manage your risk profile, but you also want the model to deliver total cash flow volatility, because that's the number relevant for strategic decision making, which is what the exposure-based cash flow risk combines then into one unified approach here, where you have the market risk exposures quantified, but also you can relate it to, it adds up the total cash flow risk, and you can relate that to your investment program and all these other things. And all right, that's the end of this presentation. Please check out my books, and as I say here on YouTube, please like and subscribe. Have a good day.